So today we are doing a new topic. Share-based payment transactions. So in a share-based, in a share-based payment transaction, you enter into a contract with an entity that you will supply goods or services. Then in return, they may give you equity, their equity instruments, or they may give you cash, but the cash which you are being given will be based on the share prices. ESOPs works the same way. Employee share ownership scheme, like I think Equity Bank has it. So you just be in a contract that you will work for this company for the next 10 years, then they will give you some shares. You work for them for 10 years, they will pay you cash, but the cash which you will be given will depend on the share prices in the stock market. So the question is, we are in 2022, and this agreement goes for 10 years. So the equity will be exercised in the year 2032. How should we just be, after signing the contract, should we be silent or we should start accounting for it immediately? The answer is we should start accounting for it immediately, because giving out shares to a company, it is always an expense on the side of the company. So you need to make that provision as time goes by during that 10 years period. So let's have some small write-ups. So you say, we are writing, say that a share-based payment is a transaction. A share-based payment is a transaction in which an entity receives goods or services. An entity receives goods or services by issuing its equity instruments. Or by incurring liabilities, for amounts based on the prices, of entities with apostrophe, not plural, on the prices of the entity's shares, or other equity instruments, of the entity. Full stop. So we are saying, let me repeat the entire sentence. A share-based payment is a transaction in which an entity receives goods or services by issuing its equity instruments or by incurring liabilities for amounts based on the prices of the entity's shares or other equity instruments of the entity. Just the same thing I explained. Types of share-based transactions. So we have 3 of them. Number one, we have what is called equity settled share-based. Equity settled share-based. Because there are three, let's just explain as we move. Equity settled share-based, you say, is a form of share-based payment transaction. Is a form of a share-based payment transaction. A form of share-based payment transaction in which the entity receives goods or services. In which the entity receives goods or services. Receives goods or services. In return, receives goods or services in return for its equity instruments. In return for its equity instruments. Return for its equity instruments. Full stop. So you give out goods or services to the company. In return, they will give you the equity instruments, e.g. shares. In fact, e.g. shares. Number two, we have cash settled share-based. Cash settled share-based. Then you say is a form of share-based payment. Is a form of share-based payment. Form of share-based payment in which an entity receives goods / services. In which an entity receives goods / services. Receives goods / services in return for cash. In return for cash. Full stop. However, the cash should be based. However, the cash should be based on the entities with apostrophe, not plural, should be based on the entities' share prices. Based on the entities' share prices. Full stop. Full stop. Last, number three. Number three, we have choice / hybrid share-based. Choice / hybrid share-based. Then you say, is a share-based transaction. If a share-based transaction is a share-based transaction in which the counterparty is given the choice of either being settled, given a choice of either being settled in cash, or equity. Full stop. That one they can ask you anytime. In relation to IFRS 2 share-based payment transaction, explain the three forms of share-based payment transactions. So we have equity settled, we have cash settled, then we have choice. So equity, the entity will receive goods or the services from the counterparty. Counterparty now is the third party. But in return, they will give them equity instruments. Equity instrument, mostly the share options and the rest. Then in cash, you will provide good services, but they will not give you the equity instrument. They will give you cash, but the cash will be based on the share prices. So they tell you, you just provide services, then we will give you cash, but that cash will be based on the share prices of maybe 1,000 shares. So, for example, to make it practical, look at Safaricom. In the year 2002, 2003, thereabout, their shares were trading at around 4 shillings, 3 shillings, thereabout. Sure. Around 2002, 2003, 2004. So that was the share price. So, Thomas, what is that? How about better IPO? 206?
206, it was 7 shillings.
What?
7.
What's the investors were on there? You go to 07, number 206. Nora Mesema invest in 204 and they were trading at 2.8. Investors have spoken. So I'm just assuming, let's assume that one of us that it was 2.8. How about today? 20 something or 30? 28, 29, 30 thereabout. So if you had agreed in that 206 that you give us goods, we will not pay you, we'll pay you in 2022. Now that 2022, you will see the share prices. So go there, check the share prices, multiply with the number. So what you agree is the number of shares. That what you will pay me will be based on 1,000 what? Shares. So ungelipo immediately, ungechukua hiyo 1,000 times the 2.8. But right now, you go and check, you have said it's 30. So check that 30, multiply by that, then you are paid cash. So the cash which you are being given will be based on the share prices. Then choice is not standalone. Yes, of course, there is withholding. So choice, the counterparty, whoever is being given those privileges, you choose, you are given an option, you can select this or this. But there are some instances, there is no option of selecting. They tell you right now, we are only giving equity, share-based, or cash. So if that is the case, you don't select. But if you have an option of selecting whichever you want, then that kind is called choice. Choice is either equity or what? Cash. So even in computation, we only do equity and cash. This one falls nowhere because nile tu umeelewa. Unaambiwa chagua hii ama this one. Yes. Adan is asking, and what about people who invested in Imperial? Subtopic there. Accounting for share-based payments. How do we account for it? Accounting for share-based payments. Subtopic. Accounting for share-based payments. So you say share-based payments are accounted for. Share-based payments are accounted for. Share-based payments are accounted for depending with their nature of classification. Depending with their nature of classification. The nature of classification here is depending with their nature of classification. So it means we are going to check them one by one. So let's start with number one, equity, settled share-based. So we want to check how equity is accounted for. Equity settled share-based. Equity settled share-based. Then you say IFRS 2 requires that an entity, IFRS 2 requires that an entity should recognize a liability. An entity should recognize a liability An entity should recognize a liability and an expense, a liability and an expense in relation, a liability and an expense in relation to equity instruments, in relation to equity instruments that have been granted to third parties, that have been granted to third parties. Full stop. Full stop. So that is what the standard requires for equity. You know, giving out shares as an expense to the company, you're aware. How does it become an expense? How does giving shares become an expense to the entity? Yes, and also especially on the earnings. You know, the earnings, most of the earnings per share is based on the outstanding number of shares. So when you give out, expect the EPS to drop. So it is always a challenge to the entity. So immediately you give out a promise of giving out the share options, the equity, then you need to expense that in the books during that period which you agreed until they exercise. So some small terminologies in regards to that, like opportunity terminologies, right? Terminologies. One, terminology number one. Vest. Yes, there is a term called vest, which you will come across. So vest, you just say something very small, to be entitled to. To be entitled to. To be entitled to. Full stop. Hivyo. Na leo mmeona Thomas hapa. Next week utasikia share based. When was it covered? Nani anakulanga notes zako? So in the question, you will hear examiner saying the options were to vest on 31st December. So it means that is the date when that third party was entitled to those options. So to vest means to become entitled to. Phyllis, vest, to be entitled to. To be entitled to. Number two, vesting conditions. Vesting conditions. Vesting conditions. Then you say, these are conditions that must be met. That must be satisfied. These are conditions that must be satisfied by the counterparty. Counterparty is the one who is being given. Must be satisfied by the counterparty. Counterparty. These are conditions that must be satisfied by the counterparty in order to become entitled. In order to become entitled to the entities, and entities here is apostrophe, to become entitled to the entities, equity instruments, to the entities, equity instruments, or cash. Equity instruments or cash. So they are normally attached to conditions. You are told you must work for this company for this period for you to get what? The shares. You must achieve a certain performance level. So if you can reduce for us the cost, you as the finance person, if you can reduce for us the operational cost from 60% to 40%, we will consider you, will give you something. So those conditions which you must satisfy are called vesting conditions. Down there are two types of vesting conditions. There are two types of vesting conditions. There are two types of vesting conditions. A, So we just start now there. A. We have what is called performance condition. Performance condition. Then you say, are conditions which requires the counterparty. Are the conditions which requires the counterparty to achieve. Requires the counterparty to achieve certain level of performance. To achieve certain level of performance. Certain level of performance in order to receive equity instruments. In order to receive equity instruments of the entity. E.g., an employee may be required to achieve a certain profitability level. May be required to achieve a certain profitability level. A certain profitability level. Full stop. Next. Hizo vitu stakangi. Ukiona mostly accountants wanakuwa kwa hiyo box na hizo vitu. Especially for private entities which are not very serious. Be careful. Atunaambiwa you are the accountant, tupunguzie cost, eh? Watu wamekuwa wakitumia petty cash vibaya. Punguza, tutakupea shares. Be very cautious, eh? Unakosana na watu, alafu at the end of the day. Mostly I know, for private entities, okay, private entities differs, but most of them, they only start telling you those things when they know they are going for funds, shaken. That's when they tell you, we want you to. I'm sorry to say this, but I was served. You find that a company, when they are doing well, I don't want to shughuli the employees, but when it starts shaking, ukifika 8, no, ndio unasikia, let us have a word of prayer before we start. We should be praying before we start working. If the entity they used not to pray every morning, then they start. It is always an indication. Kama ujue leo. Unless when you uliendanga ulipata wakiomba asubuhi, there are entities where they pray in the morning before they start. But if they were not praying, then you ask, let us have a word of prayer. Then kidogo, finance manager may resign, alafu unaambiwa you can just take over that seat. No salary increment. Lakini sasa umekuwa mkubwa. Hata wetaroka. It will just be for a given period. Next. Personally, itabidi utumiwe notes. Na utamtumia sio? Utatumiwa notes hapa. Service. Let's go to service conditions. Now, personally, you should have strong Wi-Fi. B, that is B. So you require performance. Now we are going to service. Personally, you should have strong Wi-Fi. Telcom. Anatumia Telcom. Anafaa tumia gani? Fiber. Service conditions. You say, are conditions which requires the counterparty. Are the conditions which requires the counterparty to provide services. To the entity for a given period of time. Provide services to the entity for a given period of time. For a given period of time, in order to receive the entities. In order to receive the entities equity instruments. In order to receive the entities equity instruments, stroke cash. Equity instruments, stroke cash. Full stop. So those two, Performance and what? Service. Even that one has never been a question. You explained the two types of vesting conditions. Let's go to number 3. Number 2 was vesting. Yeah? Number 2 was vesting condition. Number 1 was vest. 2 was vesting conditions. So we are going to number 3. Grant dates. Grant dates. Grant dates. Then you say it is the date when the entity, entered into a contractual agreement, with the counterparty. Contractual agreement with the counterparty. So ili sikusikizana wakasign contract. That date is called grant date. So if they tell you grant date was 1st January 21, then that's the date when you should start your accounting. Next, exercise price. Exercise price. Then you say, oh, but then there's something maybe I've not mentioned. Let me not assume. See at those shares work for 10 years, we give you shares. At this bure. No, you will still pay for them. Ni privilege umepewa kwa watu wote wamekaa hapa. Ni wewe umechaguliwa. So si ati umechaguliwa upewe bure. Achieve this, then sasa ututa. Maybe wakupea at a small price, but the fact remains you will do what? You will pay. So see at the bure. Free. So you say is the price that the counterparty will be expected to pay for the equity instruments. Will be expected to pay for the equity instruments. Full stop. Next, fair value. So fair value now one a definition general, but let me define it exactly in the context of this. Is the market value of the equity instruments. The market value of the equity instruments. Market value of the equity instruments. Full stop. And last, intrinsic value. Intrinsic value is the difference between the fair value and the exercise price. Full stop. Bas. So I shall go back there to the performance. Performance, what did we say? Are conditions which requires the counterparty to achieve certain level of performance in order to do what? To receive equity instruments of the entity. E.g., an employee may be required to achieve certain profitability level. Full stop. Illustration. Get out your past paper. Get out your past paper. Hassan, you are ready with it, eh? September 2021, question 3B. Let's start with that one. Page 31, page 31, page 31. There. Page 31. You know what got all of them are just the same. They are done the same way. So use this one to get good what? Yeah. Imeandikwa kilograms. Yeah, what is the same nani yenye kweli? Page 31. Huh? Page 31.
Yeah.
Ndio yangu fika pale. Hai. Question number? So that is September. Question 3B. So leo Boniface wanapatana na Passwell online umenyamaza. Kuna conflict. Ya Boniface anasikianga vibaya akiwa huku peke yake. Let's read the question. 3B. Peponi Limited decided to grant its 500 employees. To grant its 500 employees. How ni wengi hapo ni wachache? Ati hapo katikati. 500 ni wengi sana. I think there are few. How many companies hapa nje wako na 500 employees? Ati wengi?
All the medium companies so 200. Yes, but it's one is one calculate the years there, right? Which is not a medium. How many?
Do you know that in the supermarket, they don't hire, most of them don't hire employees direct. Are you aware? So most of them wana
some companies. The employees, the people you see in the company are not employees.
Yes, the examples are coming in, like where you are working.
The people who employ us are the company. Yeah.
Your employer is not the company where you work for.
Yes. Yes. Yes, I'm contracted.
So wamekuuza. So you sold because
like right now what body companies so I'm providing accountants.
Wao wanaenda wanasikizana huyu jamaa amesema hizo liko chini ya hii. Na wewe wakati wanakuambia wamesema huwezi kulipwa. And business goes on. So Peponi Limited decided to grant its 500 employees 200 share options each from 1st July 2021 on condition that employees still be in employment as at 30th June 2025. Is that, which condition is that? That is service condition. The company has provided the following details regarding the share option scheme. So year ended 2022 all the way to 2025. Number of employees expected to leave employment. Please underline that word expected. It is always very crucial. Number of employees expected to leave employment. Fair value of each option. For each year, you can be able to see. The fair value of the options was shillings 40 as at 1st July 2021. The exercise price of the option was shillings 15 and the par value of the company shares was shillings 10. The average market price of the shares over the 4 years is expected to be at 50. Required extracts from the financial statements of Peponi for each of the years ended 30th June 2022, 23, 24, and 25 to reflect the above transactions. So a recap, let's have a working. So before we come up with the financial statements extract, let's have a working. So recap of working. Let's have a working. So the working here, you write here, another standardized way of doing it. So to copy it for uniformity. So here you can say working. Then here you say accumulated expense. For your information, accumulated expense is always a liability. When you accumulate expense for long without paying, it becomes what? A liability. So you need to recognize a liability every year as well as an expense. So expense for the year. So expense for the year will go to profit/loss account. So all your workings for share-based, that's what you, ukiona tu any question on share-based, where andika tu kitu kama hiyo. God will bring others later. So we start 2022. So 2022, in the year 2022, how many employees were granted the options? They were 500. Then in year one, how many employees were expected to leave employment? So you subtract those who are expected to leave, they are 40. And each employee was granted how many options? 200. So 200 options. And each option, 2022, we value at shillings how much? The value of each option is shillings how much? 40. Then, because they said, check the grant dates. The fair value of the options was shillings 40 on 1st July 2021. So that's the date they entered with the contract. Kama usomi kwenye nasoma, ukasema ndio lakini naona kwenye kalamu inaangalia. Huku This side. Yeah. Yes. So that was the price they agreed at. Then you see they are saying 40 were expected to leave in year one. Expectation means not actual. Therefore, we always work with the probability. So probability, this is there are many years. 1, 2, 3, 4. So this one you say year one out of 4 years. So there were 500 employees, 40 are expected to leave. Each person is entitled to 200 and shillings 40, the price which they agreed on. But now, because all this, there is nothing which is accurate, we must always work with the probability because it's all about expectation. How much? 90? Thomas? What is it? 23? 920,000. So you recognize the liability immediately, because a company giving out their equity is a liability on their side, and also it is an expense as well. Actually. Let's go to year 2. Year 2, which is 2023. So 2023, how many were expected to remain here? 460. Expected to leave in year 2? 30. Times how many employees? Times how many options? 200. Times what price?
35.
What price? 35. Said, are we not multiplying by the number of probability? We have multiplied. So the 1/4. I'm 1/4. All that was before. Haya, sasa maneno imeharibika. Billy amesema tuna multiply na 40. You are saying 35, but Billy is saying here we use 40. Okay, so which is which? Haya, kila mtu aseme yake. Which price are we using? 30. Imekuwa 30. Naona Billy 40, Faith 40, Boniface 35, Marube 35, 40, 35. We are in 2023. The people saying 40 are correct. You use 40.
Thank you.
Hey, that is where your heart was. Kwa nini hausemi? Sasa hiyo ndio inafanyanga mtu anaanguka hiyo kitu. Inakwanga, okay, let's put it normally in layman. Umeitwa pale boardroom. Ukaambiwa, we want you to work for 10 years, then we will give you shares in this company. What will be your first question? Usifikiri mambo ya class, sasa ni mambo ya ofisi. What will be your first question to these people? Hey, hatunaanza kupewa lini? At the price. No, remember we want to give you how many shares. That will be the first question. How many shares? Then wakakuambia 200. Then the next question, at what price? Wakakuambia at 40. So as time goes by, you feel you want to exercise within, as time moves, you know they cannot change. Waseme now price umeenda ni 35. Wanangoja mpaka ikuwe 2 shillings ndio wakupatie. So utakuwa umeumia. So in equity, I'll tell you what happens in cash. In equity, the secret is use the price which was prevailing on the grant date throughout the vesting period. So tutashika hii 40 mpaka mwisho. These other prices are meant to confuse Team Alliance. Well, so 40 throughout. So the people who said 40 were accurate. So shillings 40, probability said, probability now is here 2/4 because of the expectation. But when they exercise, you use the actual price that year. So someone, Steve, Could you please repeat how you got the probability bars? Can someone online tell Steve, where are you people getting this probability? The 1/4, where are you getting 2/4? Now, online community. This one comes to how much? 1720. So 1720. But we appreciate the same employees here. So for the year, you take this minus this. The incremental is what you charge to P&L. So take this minus 920, the incremental. So Steve, you're being told by Boniface, we have 4 years. Billy, number of years. Mary, there are 4 years. Hence, 1/4 is year 1, etc. Watu wanaweza kuwa walimu, si ndio? Unaona mpaka hapo kwa ETC. So Steve hapo sawa. So incremental is how much? 800. 800. Then 2024. Na hiyo unapata mapema. 2024, it will be expected to remain here 430 minus expected to leave 25 times 200 times what? 40. Here 3/4. That is the probability, Steve. How much is that? 243. Oh, like this. Yes. Incremental is what you charge to the profit account. This minus this. Yes. 2430 minus 1720. 710. Finally, 2025. Expected to remain here 405. Expected to leave 25. 40. This is here 4/4. Give us that one. Hmm? 30/40.
Yes.
Incremental. 610. Thank you. With this working, you can answer any question. With that working, you can answer any question. So what was the question? Because this was not the question, that is just a working. So what was the question? Extracts of the financial statements. So extract of P&L. Let's start with P&L. For which year? All of them. Yes, we want for all of them. So all of them is 2022, 2023, 2024, 2025. So when you give these people, you have intention. How do you do accounting? On accruals. If you anticipate an expense, you recognize immediately. So this is a provision you are making for future. Na inakuanga mzuri because of tax. Inakuanga na tax benefit. So you come here and say expenses, staff costs. Just say provision for staff costs. Staff cost or staff expenses. So just pick the ones you make up expense for the year. This one, yeah, so this is 920, 800, 710, 610. You measure it. Yes. Then extract of the balance sheet. Extract of the statement of financial position. Extract of the statement of financial position. Extract means give us what you are capable of seeing. So have that. So this accumulated expense becomes a liability. So you can recognize a liability or as part of equity. There are options. We call them options to equity. If they want to convert in year one, this is what they can convert. So right here, let me just recognize it as equity, but you say options because they have not been exercised. Options to equity. Options to equity. If you convert year one, 920, year two, 1720, year three, 2430, year four, 3040. That is what they need to give. Full stop. How many marks? 8. 1, 2, 3, 4. 1, 2, 3, 4. 8 marks. Imeisha. Why are you trying now? Umekunywa coffee. Umekunywa coffee wanatia kulala. Sasa ama coffee zingine ni tofauti. Let's go to November 2020. Gani hiyo? If you don't want to use the word equity, you want to write liability, then you recognize as non-current liability, and you still use the same wording. So let's go to November 2020. Question 3A. Tukifanya mingi tukazoea. November 2020, question 3A. Thomas, what are they? Huh? November 2020, question 3A. Billy, how do you know if the question is cash or equity? So atujafika kwa cash, ikikuwa cash utaona tu. You'll just be able to see. The way they have structured the question, if it is cash, utaona wakikuambia unaona wakisema cash, you just see them saying cash. Straight, in that question, you'll be able to see. But they were to receive cash based on these options. So what are tukifika hapo, when we get there, you'll be able to see. So Boniface is saying page 45. Eh?
Yes.
Or thereabouts. Yes. So be there, read the question. So we read Madini. Madini Limited issued share options to its directors on 1st of January 2019. The options have a vesting period of how many years? 10 years, and had a fair value of shillings 20 million as at the date of the issue. In order to be eligible to exercise the share options, the directors are required to remain in the employment of Madini over the entire vesting period. Simunipatie tu salary alafu nijitafutie shares. Actuaries have estimated that 20% of the directors who have received the share options will leave employment. The financial year is ending on 31st December. Required. Advise the management of Madini on how to account for the share options in the financial statement for the year ended 31st December 2019. 6 marks. Tulisikizana kitu iko na computation, ukiambiwa advice lazima uongee kidogo ndio unaenda hapo kwa computation. So let's talk about something small. And what are we talking about? Yes, unaanza na hiyo IFRS 2, lakini wame-mention. No, they have not mentioned IFRS 2 anywhere. So I'm afraid, Thomas, you unasema IFRS 2. Unaweza enda kwa mtihani, instead ya kuandika IFRS 2, uandike IS 2. It's possible. Unaharibu kila kitu. Hiyo itakuwa wrong. Hata ukisema kitu mzuri. Because you know IS 2 and IFRS 2 are different. Are you aware? You're not aware? They are different. IS2 actually, IS2 talks about stock valuation, inventories, on how to value stocks below of cost and net place of value. So IS2 is on stock. So imagine unaongelea mambo ya stock kwa share. So Boniface is saying, unaanza by saying as per the accounting standards. Even ndio unafaa useme. Unasema accounting standards requires una connect hapo. Kama hii accounting standards requires that an entity should recognize a liability and an expense during the vesting period. But because now we know, tuandike IFRS 2 requires that an entity should expense the fair value. Should expense the fair value of the share options and to recognize a liability over the vesting period. Full stop. So we can help them do that. Let us help them in doing that. Weka ile structure. Year, workings, accumulated expense for the year, hapo mwisho. So Sasa hii password amenyamaza. Anasema kwa roho, yani nilisema tu mwalimu anirudilie. Akaniambia sina strong wifi. Sasa wacha tu ninyamaze. It is never that serious, ndio? So here, which year are they talking about? 20? By the waliingia hiyo contract lini? January 2019. And they require us to talk in which year? They want us to advise them in which year? The same year. So hata tuendi mbali. Tunaenda tu hiyo mwaka. That's what it is. So just that 1 year. Lakini utaongea si ati hivyo. Hiyo umesema hapo juu ni 1 mark. So and the workings, this one is not really marked. So let's come here. Wakikwambia you advise, the advice after workings, you can take either of these two, but both is not good. You can give the journal entries, or you go and give the extracts. Not ile extracts umefanya pale. So you can give those extracts, or you give the journals. You know, journals is like the extract because you are telling me which account to debit and which one to credit. So a student who gives the journals after this, and whoever gives, because hawajasema ile wanataka, whoever gives journals or whoever does the extract, those are okay. So this one I'll go for the journals. So let's go for 2019. Let's go for 2019. 2019. Let me read again. Let's go through it. The options have a vesting period of how many years? 10. So Steve, be standby. Donor probability kikuja 10 years, and the fair value is 20 million. Oh, as at the date of issue. They have already valued it. So you just come here and say it is 20, but out of this 20 million, they have already worked it out. The fair value of the option, you know, they have taken the number of directors times the options. Times the options times the value of the options. But now, 20% of the directors are expected to do what? To leave. So the estimation, we always do with the ones expected to remain. So expected to remain is what percentage? 80. But this is year 1 out of 10. So Steve, I hope you are seeing where the probability is coming from. They have already calculated the value. So you just take 20. 80% is we normally work with expected to remain. Expected to remain. You get? 1.6. So this is 1.6. 1.6. Actually, alikuwa nataka tu ya hiyo mwaka peke yake, lakini allow me to go 1 more year, assuming we were to wangeuliza 2010 ama hapo mbele kidogo. Let's go for 1 extra. So if we were to go to 2020, it will be 20. Expected to remain still 80. 80 of the work now mpaka year 10. See, you know the 20% were expected to live within the 10 years period. So you don't know how many are living in year 1, how many year 5. So expected to remain for the entire period is 80%. So 80% will be throughout. So yes, the period. But now here, year 2 over 10. 3.2. So incremental 1.6. So you will just move like that up. So how should they account for this? So if you want to do the extract, here then you just show employee cost of this, so staff cost of this, then options to equity in year 1 is 1.6. But now let's do journals. I want to do journals for a change. So journal entries.
Journal entries. So journals means debit and credit. Let me reduce the thousands. Let's reduce those thousands. Good. So the account to debit is the expense account. So expense account here is the staff cost or employee cost, whichever. Employee cost or staff cost with 1.6. Then you credit options to equity, which is an equity component or liability, also 1.6. For that particular financial period. Full stop. So it's at 20 value. That was what was required for that question. November 2018, question 1C. Wewe unaweza andika. Leo upeponi tutua, upeponi maini madini. November 2015, question 1C. Please, whoever gets the page, tell us which page. So the journals, have you advised further? Through the journals, have you advised further? Yes, we have advised them to recognize. He may advise. Well, one first. That one has already advised. Page 66. No, my paper is not moving as yours. Page 66. Well, that is how that. Unajua saa zingine exam inakuwa mzuri. Usicomplicate issue at your marks ni mingi for that thing. Unajua hiyo kitu si rahisi ukiona hivyo. Whoever has not gone to class, huwezi kufanya hiyo kitu. It is very difficult. So for the student thinking is a plus. Page 66. So yangu inafai kwa page somewhere. November 2018, question 1C. Where? I'm there. So we read. This is the question I wanted. So on 1st January 2015, G granted each of its 200 employees 500 share options. These share options were to vest if the employees still worked for the entity as at 31st December 2017, and if the share prices on that date exceeded shillings 45. On the grant date, the fair value of each option was shillings how much? 15. The share price on 31st December 2015 was 27, and it was considered unlikely that the share prices would rise above 45. 20 employees left the company during 2015, and a further 20 were expected to leave in each of the 2 years ended 31st December 2016 and 31st December 2017. During the year ended 31st December 2016-17, 15 employees and 25 employees left the company, respectively. Required extract from the financial statements of G for each of the years ended this and that to record the above transaction. So, as usual, working remains the same. I just want to delete this one. So, panga hiyo. Panga hiyo. We kick off. So we are starting with which year? 2015. For 2015, how many employees were granted the share option? 200, eh? Sasa hapa ndio tutawaruzana kidogo. 200. How many employees left in 2015? Yeah? How many left? 20 left. Then 20 left. Then there's a paragraph they are saying. Where? 20 employees, there's a paragraph. 20 employees left the company during 2015, and a further 20 were expected to leave in each of the 2 years, 2016, 2017. In accounting, provided you have anticipated, you must recognize that immediately. So 20 have left in 2015, and they are anticipating that 20 will leave in each of the 2 years. So we are expecting, I know you will say, why are we capturing 40 right now and we are in 2015? In 2015 already, they have done a projection that 40 will leave. So it's about 20 in each of the 2 years. So 2020. So they have projected that 40 will leave in the next 2 years. So you work with the expected to remain. So this is actual, 20 left, but the 40 are expected to leave in the next 2 years. In accounting, once you have that expectation, you capture immediately. So those ones are expected to leave times the number of options. 500. What was the price in 2015? The price check. Which is which? Check grant dates, if possible. Imesema mahali? Where? First paragraph, last sentence. On the grant date, the fair value of each option was 15. Kufa na hiyo 15. So the price was 15 on the grant date. Mugiga pale kwa. Hiyo washazi na discussiwa. This is year 1 out of 3 years. I can discuss about boardroom. Lakini hawa watu ni wabaya. Unajua accountants wanapewa shares. Unajua watu wanapewa shares wanakwanga. For these other commercial entities, wanaita watu wa sales. And those are the backbone, wanajitanga backbone of the company. Hao ndio wanadiscuss na wao mambo ya shares. Wanakuja wanavaa heels. So, how much is that? 350. Let's go to year 2. Let's go to year 2. So year 2, this is 2016. How many actual employees remain here?
180.
The actuals, no. So the actual were 180. Then, you know, these ones were expected, 20 were expected to live here. Then 20 were expected to live next. So the examiner went ahead and said, during 2016 and 17, what was the actual number who left in 2016? 15. So instead of 20, only 15 left, which is good. You know, in accounting, you better, you increase the number so that if all you are better. So we are overstated the people who will leave at least in the drop to 15. So the actual who remained here were 180. Then out of the 20 expected to leave in 2016, only 15 left. Then in In 2017, what is happening? That one we can, that one we cannot bother about, because to power actual next year, you know, the 20 are already recognized and full in year one. So here there is no much problem. So times 500 times shilling what? 15. That is year 2/3.
Does it mean that you have
Yeah.
the question, they only knew the seed tax 2016.
That they knew?
They don't understand why 2017 was not being included.
Provision.
Provision, like in 2016, you still know that there's a provision for 2017.
Mimi sipati kitu mnasema.
The previous question of the warning, we also knew that people were expected to leave, but we did not. We just went with 30 there alone, not minus all the rest of the year. So here we also know in 2017 there's 20 who will leave. So why are we not also?
Oh, yes, makosa ni mimi. Kuna 20.
Yes.
There is 20 for 2017. Yes, because the total was 2020, and here we had already made 40 together for this. So we are remaining with the 2017 to go, which is a provision because bado to do the actual. Yes. So minus 20. However, Steve, 15 tumepewa. Steve, tumepewa somewhere the 15 leaving. The last paragraph before required. Check there. So I'm not sorry for this. The 20 were living in year 2016 and 2017. Here we recognize in full because we need 2020. Then tukifika hapa, out of the 20, the actual 15, and we are still expecting 20 to live in 2017. Yes. So that is okay. Chapa hiyo. Oh, that is what some people are asking here. So hiyo itakuja ngapi? Yes, it should be 200 minus 15 minus 20. Faith, that is true. So, 725. Yeah? Thomas. 725. Give me the incremental. Give us the incremental. $375. 2017. How will 2017 be? I want to move with you. How will it be? The actual remaining here. 165, this minus this. 165. They expected 20 will leave. What is the actual number leaving? 25, eh? Yes. 25 left.
Minus 20.
No. Instead of 20 leaving, 25. How many 20 did I furahisha sasa? That's the last year. We made under provision. You know, we provided for me initially 20. How many have left? 25. 10? 1050. So this is 1050. Incremental. Three? 325. All right, what was the question? Extracts. So they want the extracts. So extracts of P&L. Extract of P&L. So for which years? 2015, 16, 17. Faith is saying we have double deducted 20 in year 2. Can you check that? We have double deducted. We double deduct 12. The actual will remain 180 because this one's left. 2015. That is 180. Then the 40 in year 1. There was an expectation that 20 will live here and 20 will live here. So to Kuja 2016, how many are living actually? Instead of 20, how many left? 15. And in our head, we still know that how many are going to live in 2017? 20. So faith, we have not double deducted. It should be 200 minus 20 minus 15 minus the 20. So this 20 is the expectation in 2017. Then when we go to 2017, the actual is this, which is 165. Then the people who left, actual 25, no further expectation. Because our higher. Then now we go for P&L expenses, staff cost or employee costs. Which one makes you happy? Whichever. 350, 375, 325. Then we do the balance sheet. Wewe bora ukiona tu share based kwa mtihani. Your style. Sasa najua vichwa za watu hata igongi mambo ya segmental. Watu wamesahau kabisa. Ndio. Kama tunakumbuka segmental. Hebu funga macho uone format. Unaona kitu kama hiyo. Extract of the balance sheets. So you just say equity. At least ukienda kwa mtihani kila topic uko na idea, sio? Si ati umefika, which one is this one? Unasema hii ndio utamaliza nayo. Ukienda question 2, what's that question 1? The end of the day, you want to finish with all of them. So you're buyer, but at least you have idea in all the questions. You are wondering to start with which one? 2017. The provision actually, not provision.
When you're preparing the income statement, or we say income.
Yes.
Do you say you have to include that provision?
And administrative.
And
then you will give disclosure of the same. Yes. 2017. 2017 May. Narudi hivyo nyuma. May 2017. Question 2C. Umeona hivyo? Yeah, that's one. Wale watu wa pages, mtu anaanza wale watu wa kusema page 94. Eh? 94. Kama simuona inaexaminiwa sana. Shida group. Inaexaminiwa shida group. So we read. So that is May 2017. It says, on 1st of January 2014, C Limited issued 500 share options to each of its 1,000 employees eligible for employee share ownership scheme. The fair value of each option at the grant date was 30. The options had a vesting period of 3 years, and any employee who resigned before 31st of December 2016 was not entitled to any shares. As at 1st January, the management estimated that 5% of the employees will do what? Exit during the year. On 1st January 2015, the estimated number of employees who will exit was revised. To what percentage? 8%. Actual information from the company's human resource department indicated that 24 employees left in 2014, 17 left in 2015, and 6 during 2016. Required journal entries to record the transaction with regards to the share options for each of the years. So you are doing journals for 2014, 15, and 16, 8 marks. Explain how your answer in C1 above would be different if the employees had the option to be paid the cash equivalent to the market price of the shares vested. So let's start. Hata ikiwa mbaya, wewe anza tu na ile mpangilio. Sawa? Anza na hiyo. Now, wait. What if I do this without mentioning the workings? If we change, we say here, instead of workings, we have a straight 7. The liability. So then here you just say what? The expense here. Then 2014. We say 2014 there. Then we show our workings here. So no matter how workings are chini yake, then 2015. Kama ikufurahishi. Hiyo utaki. Wewe weka hiyo. I'm trying confusion.
Not now. Next time.
So there is a problem here. There is estimation and there is actual. Actual who left. How do we go about this thing? In your own wisdom. Where andika hiyo ya kitambo. Boniface. Now this thing is confusing. Wewe shikilia ile umeshajua. It's just one and the same. In fact, I thought this one is I'm reducing the kizungu yenye unatumia. Aya. So huyu human resource, huyu HR. HR wanakuwa watu wazuri kweli. You have experience.
And to apply the HR policies.
And you apply the HR policies.
So it depends if you are the wrong or the right. So
HR, na wanakuwa wanaongeanga sana, sio? You have experience with them. Ama kuna mkutano na moja kesho. It has come to the notice of the management, right? How many employees were here? 500. Huyu HR alikuja kujua hii information at the end of 2017. At the end of year 3, all this information was being extracted each year. You know, that is the problem. Steve is saying we should treat the estimate and the actual like the previous question, in my opinion. So what will happen here? Work with expected to remain. You know, it is a provision we are making. Because how many employees do we have?
1,000.
1,000?
Yes.
Yes. It will go this way. Take 1,000 employees. Expected to leave what? 5. So expected to remain in 2014.
Yes.
Yes. 5% were expected to leave. By the way, what is 5% of 1,000? 50. And how many left in 2016, the actual? 2014, yes. 24. So if you make a provision with provision, the estimate should be up. So it is better. So inside the expected to remain, the 95% is like that actual, the actual who left, it is still okay. It goes to sour. There is no big issue. And furthermore, when do we make a provision? Do we make a provision at the beginning of the year, or we make a provision at the end of the year? The beginning, correct. Provision is made at the beginning. And that's why, when did they estimate the 5%? On which date of which month?
January.
See, at the beginning. So they did the estimation in the beginning, and provision was to be made in the beginning. But when did they realize that, hey, these are the people who have left? See, at the end of the year. So work with the provision. What talk at the end of the year when you had already made what? Provision. And luckily, the provision is higher than the actual who did what? Left. So how when you talk, well, we'll deal with them in the last year. So that is 1,000 expected to remain this. How many shares? 500. At what price? I saw the price somewhere. Grant date? 30. However, this is year 1 out of how many years? 1 out of 3. Year 1 out of 3. Please do it.
The previous question we factored in actually left this way.
But you see, if they expected to leave 5%, 5% of 1,000 we got a gap 50. And the actual who left?
But we factored both in the previous question.
I took factor both.
For which the provision was also higher.
We never factored both. You know, in this particular question, it's quite different in this sense. The 5% provision, they estimated when? At the beginning, and that's how it should be. Then, at the same time, they are saying the actual information, but which was extracted in December. You know, in that case, it means we had already made what? The provision. And when we check, it is lying within the estimate. Then the previous question we did, 15, I don't know, 15 left. 15 left, and there was expectation of others who will live in the next, in 2016, 2017. So we already knew people who are going to live. So here there is nothing like that. Upper, our to be in 2016, in 2014, they are not telling us any information regarding 2015. They are not talking of 2015. You know, it would have been different if they say 5% left, and the entity estimates that a further 20 will live in 2015. If they say that they expect some people will live in 2015, it can all happen immediately.
The same on, so it's on January 15th.
They estimated.
Yes, the estimation it was done on yearly basis. And actually next year, nimeona wame revise.
Yes.
Yes, in the previous question, if you check, the estimation was done in year 1 and waka project even the next years. But here, they are not projecting the next years. You know, wange project wangesema that in 2014 this left, and the entity estimated that a further this will do what? Will live. But hapa, wow, kuna hiyo disconnect. The completion is getting worse. So ni kizungu, soma hiyo 8%. They are saying on 1st January 2015, you know, you wameshafika 2015.
Yes.
So this is on annual basis. Wangetaka tuiweke 2014, wangesema and the entity estimated tukiwa tu 2014.
Before the year ends.
Yes, before 2014 ends. Then that one will have been a different issue. But here they are talking like they arrange it on annual basis. So Martha anasema ilikuwa rahisi lakini sasa. So this one comes to how much?
7,500.
For 70. 4750. 1,000. Now, let's go to 2015. 2015 tukifika January, wamesema nini? They revised. The people who are expected to live, they revised what percentage? 8. So is 1,000 expected to remain what percentage? So 92.
92, yes.
92% expected to remain. Huh? There? Sawa, watoto hiyo ndio safari refu. The incremental of 3%. Ama unasema nini? Hiyo actual deal na wao tukimaliza. Bado hatujui, we don't know. Tukifika 2015, because unajua tukifunga 2014, tuseme HR brought that information. Unajua tutashtuka, how many left? 24. And how our provision we allocated for how many people to live? 50. Tuko sawa. Tusonge 2015. So in 2015, again now, wakakuwa cautious. They said, Thomas, on 1st January 2015, the estimated number of employees who will exit was revised to 8%. Not 8 that you are working from 95, from 100. So it means expected to remain is 92%. Martha, what is the issue? Why not? You cannot take. Mother is asking, why don't you just take 1,000 minus 24, the actual? No, it can't work that way. The reason being of the 24, okay, 24, the 5%, the estimated 5%, umesema ni 50. So 24, siko sawa. So it is all inclusive. And when you make another provision of this, it's still okay because the estimate is higher than even the people who are living. James, What of the 5% in 2014? Si waliweka 5% wameongeza sasa ikuwe 8%. 5% inakuanga kinadia 8 ama iko hapo ndani. Times 500 ni kizungu sasa hapa kizungu itabidi. So mara huwezi leta hiyo 24 hapo because the provision you have made is higher. So 24 is just okay. Iko huko ndani ya 50. 9200. That 440. 4450.
Yes.
So that's the most serious. 4450. In 2016. 2016, what did they say? So in 2016, so how many left? The actual who left here. You know you have been making estimates. Umefunga macho ndani kujua wangapi walitoka. Bora tu wenye estimate yako iko higher than the people leaving. How many left? 324.
Yes.
How many left in 2015? 17. How many left in 2016? 6. Vision. There is no any estimation there. So yes, there were 1,000. Here you estimated 50 will go. Tukasema ni sawa. Here you said 8% will go. Sawa. But now here you come up with the actual. So this is 500 times 30. Okay, kama ni watulize roho. Si nyinyi watu wa kwanza kusumbuliwa na hiyo swali. So that one can be one assumption, but even if they were giving at the end of each year, it will have no effect. Haina shida because their provision, yeah. So you know when you make a higher provision, you are safe. Shida ni ukiweka a smaller provision, then you are in also. $14 to 95. Increase. 40 to 95. Increase of 390. 5090. What was the question? Because this is not the question. Journal entries to record the transaction for 2014, 15, and 16 for those 3 years. So I make up for journal entries. I'm changing the camera. So journal entries. So journal entries here. So journals, let's start with 2014. Mohammed is asking what if the actual exceeded the provision? We're talking what will have happened if the actual number who left exceeded the provision?
24.
Huh?
Yes, instead of 24 living, actually 60 leaves, and you had a provision for 50.
So you are asking me, you are answering the question.
We're expounding the question. We're expounding.
Me, I thought you were answering Mohammed. Si kitu gumu. Kwani when you make a smaller provision than the actual, what happens? You just adjust the difference. So like in this case, if I go to 2015 and I realize that here it was 50. So assuming if we're like 60, instead of 50, 60 left. So what will happen? Say I just adjust for the 10.
Yeah.
Huh?
How, where?
Until how, where?
When? I said all of them. How, where, when? Like in the, no, you'll
Okay, so I wanted to work a rule. Rule number 1, it cannot be like that. The provision must be high. Hakuna kitu kama hiyo. Mimi sijaona swali kama hiyo. Ati sasa umeweka provision kidogo, then you are a fake accountant. Based on previous experience, you should make a provision which is higher. So ukikataa unaweka provision ya 100%. So Mohamed, hiyo swali hakuna kitu kama hiyo. Songa mbele. 2014. Na vegetarian amefurahia. Tell us now. 2014, you debit the employee cost or staff cost account with 4750. Then you credit the options to equity account. $47.50. Narrations right here. Then 2015. You have 1 hour. We will talk about the late. I'm a Ulala town. But I think we are remaining with like 2 questions to monitor your topic. So, tukimaliza tu tunaenda. Tunamalizanga 10:30. So you are still talking. Alright, so another employee cost. All right. Why are you 4450? So 4450. So another top-up options to equity. Your account, which are the same. Wachana hiyo 92. 92 is the accumulated. So ukiweka hiyo inaongeza this plus this inakuwa 92. So bring again 4450. So that when you add this, you know it's the same account you are posting. Yeah? So we have this and this brings you 92. So for year 2, don't bring that. Then year 3, 2016. 2016 naona tutakuwa na 2 journals because that is when they will exercise. So the first one, employee cost of 5095. Then options to equity 5095. Then remember they will exercise that year. So this is A. B, eliminate the liability now. Sure. Yes, eliminate the entire liability. So options to equity account. So can you add all of them? First one is asking for prayers. Huh? Huh? That is not how it should be. In 2016, you want to acquire shares.
Yes.
They are taking up the shares and they are paying. So they will pay, sorry for that, you debit the cash book. Debit up the cash book with a total, this plus that, coming to 14. It is 14,295. This one, they accumulated 14,295. 14,295. Then you credit ordinary share capital, equity account. You give them shares of 14,295. The total accumulated. So year 2016, you will have those two. Yes, we are going for prayers, but give me like 5 or 4 minutes thereabout. So you have already cleared them. Like credit in the ordinary capital account. You can ask in a reverse too, but there is no need of reversing because you have been recognizing an expense and a liability. Then now they take over the equity. So you credit the equity account, debit the cash book. We cancel. I read part Roman 2. Explain how your answer in C1 above will be different if the employees had the option to be paid cash equivalent to the market price of the shares vested. How many marks? 2 marks. So I make up Roman 2. Well done. You say if employees were to be paid cash, if the employees were to be paid cash equivalent to the market price of the shares, if the employees were to be paid cash equivalent to the market price of the shares, equivalent to the market price of the shares, then it will have been accounted for. It will have been accounted for. It will have been accounted for as a cash settled share-based payment transaction. It will have been accounted for. It will have been accounted for as a cash settled share-based payment transaction. Evo two, the 2 marks home. Cash settled share-based payment transaction. Kama sikusema hiyo kitu kwetu si rahisi hivyo unaona. No, in our village, pronouncing all that thing. We have said it would have been purity. It would have been a bull letter nesomi. Now watu wanasema I repeat. We have said this: if employees were to be paid cash equivalent to the market price of the shares, then it will have been accounted for. It will have been accounted for as a cash settled share-based payment transaction. Cash. So that one now brings us to what Billy was asking. What is this cash settled share-based? So andika, what we have been doing is equity. So andika cash settled share-based. Martha? Wani watu wanaikisha break? Between watu wako physical na online. Nani nafaa itishe break sana? Online. So physical wanahitaji nini? Si online unasema tu si wako muted. Niletee chai hapo nyuma. Ama andika hapo cash settled share-based payment transactions. So wacha niwape small break, but what I'm sure about is that 10:30 will not get at here. Just 2 questions. Cash, I'm only doing 1 question. Other they don't examine it that much. I think we only have 1 question there. And they're the same. Actually, the arrangement kila kitu the same. Of which, kama la semester siku wafunza hiyo cash, I can tell you na mniambia atawachana nayo. There is only 1 thing small. Which nitawaambia. Okay, hata naweza waambia, but tutafanya swali. The only differ here. Wana hapa. Unajua cash, uwezi niambia tutakulipa 30 shillings after 20 years. So inflation iko. So for cash, you go with the price for each individual what? financial year. Even that's the only difference. Everything remains the same. So let's take a small break. So we'll do one question. Then there's a question, I don't know which year, around 2019. There's a question, if I don't do mitashtuka, start hiyo mambo ya kushtuka. Mkifanya mtihani, nasema haki wasilete hiyo swali. So there's a question which I must do for my heart to be okay. So just two questions then. Please turn the camera. So I think there. So take how many minutes? 5. Yani tumalize mapema. Take 5 minutes, then we come back. Break is over. Break is over. So right there under cash, you say is a form of share-based payment. Is a form of share-based payment. A form of share-based payment in which the counterparty delivers goods stroke services, in which the counterparty delivers goods stroke services in exchange for cash. Which is based on the entities, share prices. Full stop. Another event, the only difference between equity settled, between equity settled and cash settled share-based equity settled and cash settled share-based. Cash settled share-based is that in cash settled, the options are to be valued. The options are to be valued. The options are to be valued using the fair value. Using the fair value for each respective financial period. For each respective financial period. Each financial period during the vesting period. During the vesting period. During the vesting period. Full stop. Full stop. So that is the only difference. Otherwise, everything remains the same. In cash will the same at yenye tulisikizana grant date. Yo utaumia. So let's do one question. December 2017. Mlikuwa mmeshafungua? Fungua. December 2017, question 2B. December 2017, question 2B. No, all shall be well. Today you are not happy. Hata umechelewa. Hadi usiku zingine ya watu hujaipata ya. Take it easy. We shall overcome. Question 2B. December 2017, question 2B. Wale watu wa page wamesema page 84. Let nothing stress your life. It really do avoid stress. Good health for you and your children, if any, and your parents. Nini ingine? Pesa, money, full stop. Only those two things. Health and money. Lakini hata sasa uko na stress, umekuja umesalimia sana amekataa kusalimika. And football. And pesa lazima. Good health is enough. Tumesema hizo mbili. Sasa anasema health is enough. Hata ifare kaya. Which is true.
That is nice.
But sasa Adan ameongeza amesema mental health. Wacha hii help nyingine. Mental health. On 1st January, I hope we are there. On 1st January 2014, R. So Billy, I hope Billy is still here. Yes. Billy, is Billy here? You are the one who was asking me that. How will you know it is cash? So angalia venye hii swali imeandikwa. On 1st January 2014, R promised to pay its 200 employees a bonus in cash. Already on the cash settled. To pay bonus in cash. Hii yenyewe unasema give share options. Yes. In cash, that will be based on how the company's shares perform on the securities exchange. The bonus was to be paid on 31st December 2016, as long as the market price of the company shares were at 55 and above, and the employees were still working for the entity. As at 1st of January 2014, the market price of the shares was shillings 50. So that was the grant date. And the par value of one share was shillings 10. The bonus was to be equivalent of how many shares? 100. So the following information in relation to the 3 years was availed: 14, 15, 16. All employees who are in employment on 31st December 2016 were paid their bonus. Show how the bonus will be accounted for and reported over the 3-year period ended 31st December 2016. Mohammed, what is the issue? Can someone kindly share a picture of the question? Mine is missing. In which class? Mohammed, evening. Evening or early morning? Meanwhile, panga ile mpangilio. Early morning. Thomas, got your back. To me, you swallow. Mlisema niwache ile style nyingine. Liability expense, ndio. Ni huko ndio tunaenda. Mtu afanye nini kwa hiyo? So 2014, how many employees? 200. How many expected to live in year 1? Now employees living. How many? 10. How many shares? The bonus was based on how many shares? Uko mwisho 100. Yes, it was based on 100. But that year, you value them using the price for that particular period. Cash, hakuna tunaenda kwa grant date. No. Cash unaenda as it goes because economy keeps on fluctuating. So times, so 100 shares times 55. This is here over how many years? 3. Give me that. Yeah. Good. No. What are we getting? Tuachane na hizo mapoint, whatever. What do you get? 348. 33. Someone is saying the bonus was to be paid on 31st December 2016. That is when they will pay, but before they pay, you make a provision. 2015. 2015. How many were expected to remain? 190 expected. Those people who are leaving in 2015? 15. 100 shillings, how much? 58. Yeah, 2/3. Billy, have you seen how you identify cash from the arrangement? I hope. If it's cash, they must mention that they will be given shares, they will be given cash, and the cash will depend on the value of the shares. So Billy, is your question now answered through that question? How the question is framed. That one comes to 676. 676 667. Okay. Incremental 3. Higher. 2015. Nothing. 16 years. How many are expected to remain? No, those who remain, I think. 175 expected to live. 15. Yeah, 3/3. Is Billy still here? Billy, have you seen how to identify cash? I didn't even notice when we were starting. Someone says that is 960. So 960. Give me the incremental. 23. 283. Wow. So what do they want? Good. What do they want? Over the 3 years, huh? Unreported. Sawa. See, tuwachape kwa journals. So give them journal entries. Give them journal entries. Lakini ndio kiasi hapo, unless huyu mtu na mali na wewe. Unafaa kupata kitu.
You just walk up and put figures there, and you are right. They would match for you.
They should. But we are waking up as it.
You don't do that.
So 2014, staff cost obvious is an expense. Staff cost, so you debit the expense account 34833. Hakuna kitu kama options to equity. Hapo wapewi shares. Sindio? Yes. So I will not credit cash book because that cash book, I will credit cash book in 20 year, the last year. Pass. So which account? Staki options to equity because they will never get shares. Cash book, I agree, but in 2016, they will be paid in 2016. So as time goes by, which account? Provision, exactly. You credit provision account, a liability. So you say provision for staff costs. So you create a liability account 348333. Lakini mimi hiyo sisi yangu. Hadi sijui kitu inafanywa hapo. Unaandika kitu hata wewe mwenyewe wewe soma, si ndio? Unajua answer lakini hujui narration. Unless your account will ionekane proper, si ndio? Let's go to 2015. Let's go to 2015. And you have the answer, but you don't know where to take the answer. 2015, the same thing. We'll bring the staff costs of 328,333. Then you credit provision account. It's a liability account. Provision for staff costs. Of course, accumulated 328. You post the same amount. You just post the same amount, inaenda accumulate. Then 2016, I want two journals, one for the normal, then now the exercised. So the staff cost, which is an expense account, how much? 283,333. Then the provision account, provision for staff costs, 283. As. Then now, those people who are eligible were paid. How many people were eligible? 160. The last year, which gave us 900 and what? 60. So eliminate the liability. So debit this account, this one, the provision. So we call it post for your liability account. So this is A. B, you come and say provision for staff costs, 900 and what? 60. The whole amount. Then you credit, you know, the company is paying them. In equity, they are the people paying the company. So you debit the cash book. But in cash, wanapewa 960. Examiner akipenda kutupea hizo marks atupatie, kama hataki sawa. There is one question remaining, which if I fail to do, alafu mtu anipigie simu after exam, mwalimu Shabest was there. Nitamuuliza inakaa aje? So sitaki kuuliza hivyo. Nikifanya hiyo there is no need. Ukipiga na kamera tu ni sawa. Because I know they will not bring something very unique out of what we have done. So write for me a subtopic there. Exemption, a subtopic, exemption to the valuation of options, exemptions to the valuation of options under equity settled share-based. Under equity settled share-based. Under equity settled share-based. Like a small exemption somewhere. So you say the benchmark is that options, under equity, options under equity should be valued using the fair value, on the grant date, throughout the vesting period. Using the fair value of the grant date throughout the vesting period. Full stop. However, if the options are exercisable, before the vesting date, if the options are exercisable before the vesting date, then they should be valued. Using the fair value. Using the fair value for each respective financial period. The fair value for each respective financial period. Fair value for each financial period. Full stop. What are we talking about? Ama mmeelewa kwenye imeandika? Let me summarize it. The benchmark. Benchmark means ideally the way it's supposed to be done. For equity, you use the price which was there on the granted. When you multiply, that's how you value the options. That is the benchmark treatment. However, if these people are saying, anytime ukijisikia, just come and take over. You know, in the questions we have been doing, you are being told those who are eligible will exercise at the end of your period, like this one at the end of 2016. But there are some instances you are given option to exercise any moment. So if they are exercisable at any stage, if you feel like, then use the price on that date. That is an exemption. If they are exercisable at any moment during the vesting period, then now we do them as cash. But if you have to wait until the end of the vesting period, then you use the price which was there on the grant date throughout. 2019, November, that is the last question. Kuna mtu alikuwa na usingizi hapa wenye usikia last question, niona amechangamka. Hivyo ndio usingizi na kuanga, sio? Hata siku yenye usingizi najua hakuna watu early morning. Siku usingizi imesikia hakuna early morning, sinapoteanga 3. Lakini ikijua unafaa uamke. Hiyo ndio siku. Yulizio na mkanga 6:28, no? Wale ukiamuka hiyo late, what do you do? Unafanya nini ukiamuka late for job ama class? What do you do? Wengine wanakasirika. What you do, you unacheka tu alafu unasema it is life. Kuna haja ya kasirika for yourself. Which page? What were page? 54, page 54. 53, 54 there about. Even hata walimu wanapichanga hiyo shida, lakini wanafunzi watakangi kuelewa. Especially teachers wenye wanafunza limone. Unapata ndio ufike hapa labda mtu anafaa kuamka 5. Inafika hiyo 5, unaanza kuota uko class. Yes, unafunza. Give us the UPI. My friend. Unaamka unapata 3 missed calls. Which question?
3D.
3, question 3D, D for dog. Question 3D. Yes, that is the question I wanted. Hiyo nikishafanya hata sasa mtihani ikikuja ESF. Na hiyo swali tuiangalie na macho 2, 4, 5, 6, 7. Tufanye maswali ngapi? But there's something I'm not understanding. Are we too slow or because syllabus na tusukuma lakini ile pressure tunaweka pia ni mingi na tumaliza? What is the problem? No, are other people suffering like us? So the struggle is everywhere. Oh, kama sisi pekee sawa. But you see, but they can't step on it to me. I don't. Ifrs. Si kama si na mwaka imedivadiwa mara 2. Hata si yote. Reconstruction hata inaenda kuwa unit. Group inafanywa the entire semester. Plus try one academic year. Hiyo group inaendelea. Hili hapa. But then there was a complaint in January. People complained and customer wakaona hey, hii itafikia stakeholders. You know stakeholders, kuna serious stakeholders in customer. Who are they? Yeah, treasury. Treasury is a serious stakeholder in customer. So customer wakaona hiyo kitu imefika treasury because that treasury walikuwa wanajaribu kusema hey, how can you train people professionals for 2 months then customer wakatoa barua kubwa. Ile iko na kizungu ya however. So they said the normal preparation should be 6 months. Students are supposed to do exam after 6 months. So whoever feels you are ready, if you feel you are ready, you come. But who are CASNEP students? Hata CASNEP wakisema mtihani ndakuanga every Tuesday. Tunakuja weekend tunapitia. So shida ni CASNEP na nyinyi. Nyinyi mko ready. You want to be ready throughout. You know kitu tulikuwa tunafanya na 6 months, karibu 6. Tulikuwa tunafunzana January, February, March, April. Then May tunafanya blogs. Wanafanya mtihani hapo towards the end of May, June. Sasa inakuwa Januari, Februari. Na hiyo Januari watu hawako. Watu wanangoja results.
Lakini sisi mnasikia kwa income.
Thanks to.
Kitambo it used to be times 2 in a year. Right now it's
Ngoja kwanza ati teachers are feeling well.
Yes.
or rather the honors of
They see it like you.
Stakeholder.
The stakeholders that are nyinyi.
because I need kupanga na hiyo sana.
Ni sawa, lakini ngoja. Even me I thought the same, that the school will feel well, people will be paying this 3 times in a year. The bottom line is no. It's the same. I can tell you. I analyzed and Kapata is the same. The cash flow is the same. Yes, it's the same. I can prove.
Unless the number of students.
No, in Ikoivi, what happens? Which semester? In which semester? I can prove to you which semester. They started when? August, September, thereabouts. The exam will find you August. So ndio. Exam ilifanywa August. Na sisi pia tukafungua hiyo August. Haya. Results zilikuwa zimetoka watu wakifungua. Inakuwa zimetoka there in September. So what is happening? You find that now unajua results imetoka, exam imefanywa August. Then tunafungua after 2 weeks. So 2 weeks mtu anangoja results. Unajua wakuji. Then anasema wacha ningoje results nione kama nimepita. Results zinakuja to mid September. Mid September we have already done 5 topics. Huyo mtu anasema hapana. Hapa nitatupa. Kuna haja ya kulipa fees. I'm coming back in January. So the large proportion of students here hawakufanya exam ya April. They never sat for April. But walipita, so they relaxed, wakarudi sasa this semester. Then a large proportion will not come in January, but January inakuanga mzuri because wanawanga results in December. So unapata the number of students wamegawana half. If the school used to operate 2 semesters with let's say a population of 1,000, utapata ni 500. So 500 wanakuja hii, wengine wanapumzika, wanakuja hiyo ingine because of the time period. So unapata cash flow the same. So hakuna change. Kama umeona? So it's the cash flow is the same.
But CASNEP no.
No, CASNEP no.
CASNEP will get
No, even CASNEP the same. Yes, even the CASNEP the same. The population goes down. Kama ungepata 30,000 students in a setting, wanapata 15. Wengine wana relax. Then when your results imetoka, unapata hii group tena ime relax ile ingine. So what is there is constant cash flow, constant small cash flow. So, yes, Neo. Si hata wewe ulipumzika for how long? Yeah. So it's the same. Hata wewe haukufanya hiyo ya. Yes, so many. I know so many students. When you are studying, most of them hawakufanya exam ya August. They start in April wakapumzika ndio sasa wamerudi. When you are sit August, results ikarudi late. Wakaachana nayo. So they will come in January. So the cash flow is constant, but constant small cash flow. Yeah. So the schools are not really well. Lakini primary school ndio wako sawa. Nisikukumbushe hiyo story. Wait, let's put this question. Let's do this question. Remember, we have pastors here who are going to church. On 1st January 2014, Wale Limited granted its 500 employees options to buy 1,000 shares each from the company on condition that they continued working for the company until 31st December 2016. Okay. During the year 2014, 35 employees left, and it was estimated that a further 60 will leave in 2015 and 16. During 2015, 40 employees left, and it was estimated that a further 25 employees will leave in 2016. During 2016, 22 employees left. As of 31st December 2016, 150 employees exercised. Let's scare you. 2016, 150 employees exercised their options. Another 140 in 2017. And the remaining 113 exercised their options in 2018. The terms of the options were that the company would pay for the shares on behalf of the employees. Hey, that is nice. The fair value of the shares were as follows. 2014, 2018, the prices you can see. Required, the amount to be recognized in the income statement as an expense for each of the 5 years, and the liability to be recognized in the statement of financial position. So in this question, our working is sufficient. At 20 past working, ebu soma hiyo required, read the required, to be recognized as an expense. It means they want you to compute the expense for each year, and also as what? A liability. So when we do that working, the liability and the expense, that is enough. Yes, so the workings, our workings is going to be sufficient. So now, what makes this question different with the other equity we did? The difference is when you read the question, they were exercising before even the period. So if you realize they're exercising before the period elapses, then in that case, you don't use the fair value on the grant date. Unatumia for each respective year. That is how it goes. Because kama wanatupea hiyo masharti, then now it goes like that. You value them as cash. So if they are exercisable during that period, then just value using the prices for each respective year. Let's start. Working tuliwatana na hasa tuliwacha sio watu waendelea liability then expense. So once we are done with this, that is all. They want us to show them expense and liability for each year. So this one is sufficient. And by the way, only last sitting sijaona share-based, and share-based iko na sister topic inaitwa employee benefits. The two never misses in exam. One must be there. Last sitting ni kama zilikosa. I never saw a question on both, which is very serious. It's very serious. No, sorry, I'm sorry. Ilikuwa share-based was not there, but employee benefits was there. Ningeshangaa. That one would have been. Employee benefits was there. Share-based is standing a very good opportunity. If you check all those three things, it is either share-based or employee benefits, one of them. So now 7 or both. It is either one or both. This one now is standing a good chance. Or they can bring both. But the two missing inakuwa ngumu. Very difficult. So ikikuja si mtachukua venye iko. Asante. Alright, so 20, which one? 14. Na mtu asikushtue akikwao already wamemaliza syllabus. That is not your problem. Ndio kumaliza syllabus is not an issue. Hata mimi ningetaka kumaliza ningekuwa nimaliza kitabu. Si tunafanya tu swali moja moja. One. We are done, and we can walk around telling people we are finished. So wale watu wanaishia block release. Si leo tumefanya question mpaka na blocks. Do you still need blocks for checklists? This is enough. So how many employees were granted? 500. How many left in 20 which one? 14. How many employees left? 35 left. Then check for me what they are estimating. 35 left, actual. Then they are estimating how many will leave. Where are you getting those figures? On condition that during 2014, 35 left, and it was estimated that a further 60 will leave in those 2 years. So 60. Hapo tuko sawa? Haya. How many shares? 1,000. At what price? 70 what? 72 in 2014. 72. But now, hey, you be very keen. You be very keen. Very, very keen. Inaenda mpaka which year?
2018.
I would have been 5. Yes. The probability goes up to 2016. Why?
Estimated.
Estimated. Because
Estimated to leave in 2015 and 2016.
yes, a busoma condition uko juu. On this 1,000 shares each, that they continue working for the company until 31st December 2016. Then ukiangalia 2016, 17 and 18, kazi yao ilikuwa ku exercise. So when they start the exercise, hakuna mambo ya probability because exercise is the actual number. It's the actual one exercise. See estimated. So here you will go for 2014, 15, 16. 16, 17, 18, they were exercising. And exercise is based on the actual, not estimated. So here you go for year 1 out of 3. Kindly. Yes, Mohammed, the exercise, the option. 97, 20. Can we work in thousands? Ama? See, we reduce this one, sir. 97, 20. That is fine. Just I will make sure. Would have missed shule after finishing. Are there people who are finishing about data analytics? Lakini bankers, people who are here who are bankers, especially wale wana appraise loans. Huwezi enda customer who say you are doing that analytics because niligundua wenye wanafanya hiyo loan appraisals, they do a lot of extractions of data. Ama? Credit controller. There's a lady who told me yesterday that she has been exempted from that analytics. From this class.
From this class.
I mean, maybe because I might attend this park seminars, I'm registered at this park already. Because you can register as in progress. Yeah, I don't know. Anaitwa Zamza. Hata nilisomanga na yeye. 2015 tafute. 2015, I want you to tell me the guide. How do we go about 2015? I start with which figure?
500 minus 35.
Yes, you find the actual,
465.
465. You know, 60 was estimate.
Yes.
So go for the actual who left in 2015. 2015, where are you?
40.
During 2015, 40 left. And we are estimating out how many?
25.
25. Hapo tuko sawa?
Yes.
Yes. This is the actual number who left, this minus this. Then 40, out of the what we are estimating, 40 has left. Another estimation for 25 times 1,000. Now you multiply with 77.5. When you realize people are just exercising, you treat it as cash, even if it is equity. Here 2/3. Unapata ngapi? Hmm? 20? 20? 20,000?
Yes.
Is that okay?
Yeah.
Tana hiyo. Accounting is based on estimates. Eh?
Yeah.
Get me the difference.
Nine, 4, 7.
9, 4.
7.
Now, Adam, you are saying you are there. Where? Here, 535 left, but there's a provision of 60. But when we come here now, the actual who left, this minus this, which is 465, 40 left in 2015, and we are estimating now in 2016, how many will leave? 25. Then price we say when in the question, ile exemption, you're not tuliandika. When you realize in the question these people are exercising within, then what you do, because like 2016, there is an exercise which took place. So if you realize the question, the exercise is taking place during the vesting period, then now you don't stick to the price which was there on the grant date. You value them on each respective financial period. So it is about you to be very sharp in the exam to tell that these people are exercising within before the vesting period comes to an end. But if they are not exercising, then there is no problem. Yes, the exercise was done in 2016, which we are heading to. You're here to end up. You know, we should value them until the end. But in 2016, bado kuna people who are being estimated. There are some people who left. Now in a roll back 2018. See, you were exercise back 2018. Yes. So what I want. So in 2016, 2 things happened. There are those people who exercised. So if there is exercise, deal with them first. Deal with the exercised first. So exercised, how many people exercised? 150. So 150 exercised times the number of shares, 1,000 times the price in 2016. 90 what? 91. How much? So multiply that one. 13. 13. 6. So don't recognize an expense there. Once they have exercised, it's no longer an expense, but equity you will have to give them. Then unexercised. Unexercised, you go back to 2015. In 2015, how many remained? The actual. This is 425.
Yeah.
So you will take 425 minus those who have exercised wametoka. How many? 150. How many left in 2016? 22. Times 1,000 times shillings 91. This is here 3/3. So Adam, here, this exercise in a 5-year mission. But now you see they are exercising, then there are some people who are. So hapo kuna there's issue. The exercise should be the people who are remaining. We were supposed to have only this. Then that would have been something different. But here there are those who exercise, then again there are some who are leaving. So it's totally different. Yeah? 23? 23, 0, 23. So the expense, actually, this one, here to get letter somewhere here. Just for so incremental, just take this minus this one here. But are people who have exercised. Well, so just take this, but you get the incremental. 2356. All right, let's go to 2017. I'm changing the camera. I hope what a negative the better. All right, 2017, what happened? On exercise. So, sorry, 2017 exercise 140, 1,000. At what price?
107.
107. Give me that figure.
14,980.
14?
980.
980. Don't bring it in that column. Just for accountability. 14,980. Somewhere there. Then unexercised. Unexercised itakuwa aje? How many people remained in 2016? Angalia vizuri. How many remained in 2016? 253.
Yes.
Joshua.
Yes.
425 minus 150 minus 22. 253 minus those who have exercised. 140. Are there people? Times the shares. Times shilling how much? 107. Twelve 091. There is no expense to recognize because that one is even more. So there's a reduction in liability. If the liability goes down, there is no expense you need to capture. Then in 2018, exercise. How many people exercised? The remaining. So hii tukitoa hii inabaki hiyo wanasema 113. Sawa. So the remaining 113 exercised. Times what price? 125. 14 sample. 14 125. Hakuna liability, hakuna expense. Hiyo kitu iliisha. I suspect they will bring this kind of question sooner or later. Soon can be 5th of December. Na kuna Wambua ako wapi? Wambua alisema yeye mtihani yake ameandikiwa 15th December. Au kwa it was not a joke. Aliandikiwa. Hey, please check your timetable. So alienda wakamchejea. Kuna mtu aliandikiwa mtihani yake inaanza 15th. So angefanya aje? Uambie employer mimi yangu inaanza 15th, alafu hiyo 5th ndio umetumwa outside the country. Then unaharakisha urudi 13th. Alafu wewe ni wale intro. Wewe hata kuna mtu unauliza kwa class. Group ya usomangi, kuna watu wasomangi group. Wakiona charts ni mingi kufungua na kufunga. Ukienda kwa center, unapata center yako ni Parklands Primary. Unapata watoto wamekaa hapo nje. Unasema sasa, unaanza kusema I want to sue Casnet. Na ukiangalia all savings zako ulikuwa nazo zote, pia umenunua, kuna kitu umenunua juzi mpaka umebaki na deficit, hauna pesa and you want to sue Casnet. Thomas, umebaki tu na 5,000 peke yake. Na si ati umewest, alafu unataka kusue Casnet. Ukitafuta lawyer anakuambia, jueni rafiki yangu acha tuanze na kazi. Unakoja next year by default. Disclosure requirements, we are finishing this. Niandike hapo. Disclosure requirements under IFRS 2. Disclosure requirements under IFRS 2. What do you need to tell us? Disclosure requirements under IFRS 2. Number 1, the type of share-based payment. The type of share-based payment. Hata watu online hapa naweza wafanyia evaluation. The number of students expected to leave during class session. Inakuanga between 4 to 5. Wamalizangi. Tukianza na teremkanga pole pole. Ni dara inaishanga ama engagement. Kama wewe unatokanga kwa nini? No, beauty wewe utokangi, lakini kuna the number, it is normal. Inakuanga normal because the number of students expected to leave inakuanga between 4 to 5 bundles. That is normal. So number 1, the disclosures, the type of share-based payment. Number 2, the fair value of the options. The fair value of the options. Mark and Dika. The fair value of the options. Then 3, the vesting conditions. Vesting conditions. How many vesting conditions do we have? How many vesting conditions do we have? 2, performance and service. And finally, the amount recognized as a liability. Amount recognized as a liability, stroke expense. Stroke expense, full stop. Let it end there. That is sufficient for share-based until we meet in exam. So when we meet in our next class, the joint, andika hapo IS 19. IS number 19, employee benefits. IS 19, employee benefits. Yeah. So now, employee benefits, put a lot of theory to be written. Can I, instead, you to waste a lot of time. Can I share them? You write them during the week, so that when we come, we just spend like 10 minutes to discuss. Come on, sababu kwa wiki ndio tuna draw lines, ni mingi. Hii hatuwezi maliza. Ama ni I get them typed, ni watumiki to type.
Yeah.
Sindio? That will work. Wacha itengenezwe, ni watumie either kesho ama Tuesday. tukipitia hiyo tutamaliza just like this one, then all shall be well. We are not bad off. If kama tuko bad off, then everyone should be bad off because we are trying. So thank you. Day class wenye wako hapa wa day. Hiyo class ya kesho tulikuwa tunapanga makeup. Wacha tupatane normal class on Tuesday. It is not a matter of death. Take a break. You also need to read. Let's meet on Tuesday. Thank you. When you're under kanisa, remember to pray for everyone.